Rec- For this session, we will talk now about your tax on gains on dealings and property. Tax on gains and dealings in properties. So we said your gross income normally composed of your passive income. Then we have your gains or dealings. Then we also have your business or professional income. Then we have your compensation income and other items. So we're done discussing passive income and also we're done discussing your other items of gross income. So we go now to your gains or dealings in properties. So let's look now and review again the tax scheme on your gains or dealings in properties. So the first tax scheme that you need to determine here is again whether it is subject to RIT or CGT. So we said before, under passive income, some is subject to RIT, some is subject to final tax. So for dealings in properties also, some will be subject to RIT, some will be subject to final tax. So the main question is, when is it subject to final tax and when subject to RIT? So first, you determine whether taxpayer is engaged in business. If your answer is yes, then you need to classify the assets. If your answer is no, generally it is a capital asset. As a general rule, it is a capital asset. Now, how do we classify the asset? We classify the asset regardless whether it is an ordinary or as to whether it is ordinary or capital. So when can we say it is ordinary and when can we say it is capital? So generally, the main reason that we classify an asset as an ordinary asset is dependent on the nature of the business and the usage of the asset. So if ever it is part of the inventory of the company or business, then it is an ordinary asset. If it is used in the business, then it is an ordinary asset. So let's say, for example, you have a land and that land is used as the ground for the operations of the business. Therefore, it is used in the business. It is considered as ordinary asset. So if ever it is an ordinary asset, then it is subject to RIT. But if it's a capital asset, then you determine whether it is subject to RIT or CGT. Now, what if you are not engaged in business? It is purely a capital asset. Then again, determine whether it is subject to RIT or CGT. So for capital assets, whether used in business or not, then you determine if RIT or CGT. For RIT, you only add it if it's net capital gain. Add if it's net capital gain. Because if ever that is not capital loss, it is not reported. Okay, not reported. So what we will do here is we will only carry it over. But for RIT, take note, ordinary gain is taxable in full, ordinary loss is deductible in full. So yung ordinary gain pala natin, saan may ilalagay? May ilalagay yan sa non-operating income. Ordinary loss, it is part of your deductions. While for RIT ng capital assets natin, we have only net capital gain under non-operating income. How about net capital loss? It is not deducted as a rule. It can only be carried over. Now, for capital assets subject to CGT, we only have two items subject to CGT. Sir, ano yon? First, domestic stocks directly to buyer, 15%. Real property classified as capital asset, 6%. So although we have already discussed this before in our introduction as to the tax schemes, we said your tax scheme is either RIT or final tax. For passive income, the final tax is known as final tax on passive income. For dealings in properties, we call the final tax as CGT. And what are the items of CGT? Only domestic stocks directly to buyer at 15% and real property classified as capital asset at 6%. Okay? So once you can draw that in your mind, that if ever it is based on the business or an asset of the business, you need to classify the asset. If not, as a rule, if that is a personal asset, purely it is a capital asset. And a capital asset can be subjected to RIT or CGT. Let's say, for example, I'm engaged in business and I'm using my cell phone to answer calls or to text my clients, etc. My cell phone, therefore, is classified as an ordinary asset. But what if I'm not engaged in business? I only have my cell phone. The cell phone is considered as a capital asset. Another one, um, a table. Table used in business can be classified as an ordinary asset. But if not, then uh, if I don't have a business, then I can classify the table as a capital asset. So as a rule, personal assets, personal assets, since you are not engaged in business, is a capital asset. Okay? And a capital asset can be subjected to RIT or CGT, while ordinary assets always at RIT. So I hope you still remember this one when we discuss it during our introduction. So let's go now to your dealings in properties. So we said it is proper for us to classify an ordinary asset and a capital asset. So first, let's define a dealing in property. A dealing in property, it refers to the disposal through sale or exchange or other disposition, including pacto de retro sale and other conditional sales of an ordinary asset or a capital asset. So if there is a transfer or dealing, whether that is sale, exchange, or other disposition of either ordinary asset or capital asset, we call that dealings in properties. So when can we classify it as an ordinary asset? We classify an asset as an ordinary asset pursuant to Section 39A of the NIRC. And what does your Section 39A tells you? Section 39A tells you that stock in trade of the taxpayer or other property of a kind which would be properly included in the inventory is part of your ordinary asset. Earlier, we said if ever it is part of your inventory, then it is considered as ordinary asset. Another one is stock in trade. In short, it is part of your normal or ordinary course of business to buy and sell stock. Therefore, we call that your inventory. Next, property held by the taxpayer primarily for sale to customers. So any type of inventory, again, for sale to customers in the ordinary course of business is an ordinary asset. Used in the trade or business, property used in the trade or business, then it is considered an ordinary asset. Real property used in the trade or business is used or classified as an ordinary asset. Therefore, if you try to look at this, the first two is held for sale or an inventory. The second two is used in the business, which why it explains the reason why we classify the asset according to nature. What's the nature? If ever it is inventory. Another, according to usage. If ever it is used in the business, it is classified as an ordinary asset. Now, what if it is not held for sale or inventory or not used in the business? Then it is classified as an capital asset. So if not classified as OA, not an inventory, not used in the business, then it is a capital asset. Okay, so hopefully you can now properly classify ordinary and capital asset depending on the definition pursuant to Section 39A. So ordinary asset are those held for sale or inventory or used in business. Then if not ordinary asset, then it is a capital asset. So let's look into the special rules in asset classification. First special rule that we will learn is for real estate company. Real estate company. So when can we change the classification? Meaning from ordinary to capital. So we can change if ever the asset is not have been used in business for more than 2 years. So if you don't use the asset already for more than 2 years, then we can change from ordinary to capital. But take note, normally this is only applicable for business not engaged in real estate business. So as a rule, therefore, for a real estate business, laging capital siya. Laging capital siya. Ang hirap mag-change from ordinary, from capital to ordinary. Pero from ordinary to capital, pwede. How about if ever you will change from real estate to non-real estate. Pag real estate ka dati, tapos naging non-real estate ka, take note ha, is still considered as ordinary. Still considered as ordinary. Real estate pala, generally, ordinary ang assets mo. Bibihira ka magpapalit into capital. Next, real estate, unable to operate. If you were not able to operate, is still ordinary assets siya. So as a rule, real estate company, ordinary assets yung properties niya. Bibihirang capital. How about bank and trust company? Bank and trust company. So what is considered as an ordinary asset? So real and other properties, including stocks and securities acquired by banks for clients' loan settlements or foreclose, is considered ordinary asset. So for example, nagpautang ang bangko. Tapos, di ba pag nagpapautang ang bangko, they will let you mortgage your property. So, it can be a chattel mortgage or a real estate mortgage. So, the mortgage property is used as a security for the loan. Nagpautang ang bangko, nagbigay ka or nag-execute ka ng real estate mortgage or ng chattel mortgage. Now, let's say that hindi mo nabayaran yung utang mo. So, ang ginawa ng bangko, finorclose niya yung real property. So, at the time of foreclosure of the real property, how will we classify the real property? Ordinary or capital? We classify it as an ordinary. Why? Because it came from the ordinary course of the business. Ano yung ordinary course of the business? Pagpapautang. Ngayon, ang kapalit or bayad nga lang ng pagpapautang ay hindi yung pera mismo, kundi yung property na finorclose mo. So since the property came from the ordinary course of the business, then it is classified as an ordinary asset. Take note, real or other properties that is considered used for loan settlement or foreclosure will be treated as an ordinary asset. How about a capital asset? A capital asset are assets of a bank and trust company for stocks and securities owned by them. So any stocks or securities owned by banks are considered as capital asset because normally this is not already about deposit or lending. Okay? Not already about deposit or lending, therefore it is a capital asset. Again, for bank and trust company, if you foreclose properties in payment of loan settlements, then it is considered ordinary asset. Capital assets are your stocks and securities owned by banks. Now, since we already learned how to properly classify your assets, now we determine the tax basis of your gain or loss on dealing. So, we learned a while back, if ever you're engaged in business, your answer is yes, you classify it as ordinary or capital. If your answer is no, it is always capital asset. And for capital assets, take note, it can be a real property or a stock sold directly to buyer. Stock sold directly to buyer. So, if ever the gain or dealing comes from real property, the tax basis is at gross because gain is presumed. So for example, you sold the property worth 7 million. The cost is 5 million. The tax basis is 7 million. But what if that is all other properties? You tax it at net. So for example, you sold a property. The property is considered as an ordinary asset. So ordinary asset, then we will tax it at net. The sale price is 7 million, the cost is 5 million, then tax the 2 million. We tax it at actual gain or loss. So when will we apply actual gain or loss? Ordinary asset and a capital asset not classified as a real property. So if that is a capital asset, or a sale of a domestic directly to buyer, then actual gain or loss. Ordinary assets, actual gain or loss. Other capital assets, actual gain or loss. Okay, tandaan yan ha. Sa capital asset, ulitin na lang natin to. Sa capital asset, pwedeng RIT or CGT. Ang laman ng CGT mo ay real property and stock directly to buyer. Pag nanggaling yung dealing sa ordinary asset, capital asset subject to RIT, or stock directly to buyer, we get the actual gain or loss. But if real property yan, we get the presumed gain. Okay? So dito at net siya, dito at gross siya. So look in our example. If that is a sale of a property classified as capital asset, we tax it at the gross amount of sale, which is 7 million. But if that is a property ordinary asset, we tax it at net, which is 2 million. Okay? Why is it important for you to determine the tax basis? Because it will help you to compute for the tax due. Because tax base multiplied by tax rate will give you your tax due. What's the tax base again? Tax base for all other properties are net. For real property subject to CGT at gross. So let's start now on our first CGT, the CGT on real property. So what is a CGT on real property? A CGT on real property is a tax on the gains presumed to have been realized by the seller from the sale, exchange, or other disposition of real property classified as capital assets located in the Philippines, including pacto de retro sales and other forms of conditional sale. So as a rule then, if that is a real property classified as capital asset, it is subject to CGT. What is the exception? First, your land reform. What is this land reform? For any sale due to CARP or the Comprehensive Agrarian Reform Program, if the lot is covered under CARP, the sale there is not considered taxable. It is considered exempt on the CGT. Another, a sale for socialized housing to National Housing Authority is not subject to CGT. Lastly, the sale of a principal residence is not subject to CGT. So, when can we say that the sale of principal residence is not subject to CGT? The following are the requisites. First, what was sold was the principal residence. Take note, principal residence. If there are too many residences, if that is the principal or main residence of the taxpayer, then it could be exempted. Next, it applies only to the citizen or resident alien. If ever that is NRA, it is not applicable. Why? Because for sure, they don't have a principal residence here in the Philippines. NRA has no principal residence here in the Philippines because they are not a resident. So since they are not considered resident, then they cannot claim an exemption here. Another, the proceeds of the sale was invested in acquiring a new principal residence. This talks about utilization. This talks about utilization. So let's say, for example, the selling price is 7 million. The cost of the property sold is 5 million. Now, you purchase new principal residence for 10 million. So did you utilize the whole 7 million? If ever it was invested in full normally for the new principal residence, then it could be exempted. Next, the notice to make such utilization was given to the BIR. So you will notify BIR within 30 days from the date of sale. 30 days from the date of sale. Normally, there is a notice based on 1706 that is for the CGT. At the same time, there's a sworn declaration. Okay? Next, the proceeds of the sale is to be used 18 months from the date of sale. So pag bibili pala tayo ng bagong principal residence, dapat magamit natin yan within 18 months. So yung 7 million, gamitin agad natin within 18 months. Sir, what if hindi natin nagamit? Then it is now taxable. Next, there is a cash deposit made on an accredited bank. We call this one your escrow. Okay? So escrow deposit. You will deposit in escrow the amount of your tax due. Deposit in escrow the amount of your tax due. And you can only avail once for every 10 years. The most important thing here is that you must utilize it within 18 months and then availed once for 10 years. All other else, madali na lang i-gets eh. Pero yung period, huwag ninyong kalimutan. 18 months and then 10 years. Take note, NRA is not applicable. So what is the effect then if ever we sold our principal residence? As a rule, it is exempt if the requisites are present. So how do we tax it? So generally, if ever what you sold is a principal residence, it is exempt if all the requisites are satisfied. Mainly, you use it within 18 months, and that is once for the 10-year period. Therefore, if that is full utilization, it is considered exempt. Now, when it is taxable, pagka partial utilization. So in our example a while back, our price is 7 million. So the selling price is 7 million. The cost is 5 million. The cost is 5 million. Now, if we purchase a new principal residence, let's say for 10 million, did we utilize the whole 7 million? Yes. But what if we only purchase for a new principal residence worth 4 million? Worth 4 million, then it is not full utilization. Kasi 7 million dapat 4 million lang yung ginamit natin. So if partial utilization, it is taxable. So how do we tax it normally? So we said it is 6% of the selling price or the fair market value. So let's say 6% of 7 million. That should have been the tax, right? 6% of 7 million. That is 420,000. So that should have been the tax. If we use it all, 10 million, the tax due is now 0. But if we did not use it all, 4 million lang ang ginamit natin, we are taxable on the unutilized. We are taxable on the unutilized. So what is the unutilized? The unutilized portion is 3 million. So 3 million out of 7 million multiplied by the tax due of 420,000 unutilized divided by the total selling price multiplied by the tax due is your total tax due. Okay. So 3 million lang divided by 7 million times 420,000. Then, ang tax due natin ay 180K. Sir, bakit ganyan yung formula? Unutilized all over selling price times tax due. Because normally, the tax due, ang basis niyan again is selling price or fair market value. Okay, let's say for example, pansinin nyo to. If the selling price is 7 million, the cost is 5 million. But the fair market value of the property is 8 million. Let's compute for the tax due. The tax due is 8 million multiplied by 6%. 8 times 6% will give you 480,000. Now, sinabi natin na 4 million lang yung utilize mo. You utilize only 4 million. So, ang gagawin natin, ang unutilized natin ay 7 million less 4 million all over the selling price of 7 million multiplied by tax due of 480,000. You will get 3 over 7 multiplied by 480,000. You will get the amount of 205,714. Okay? Kasi pag ganyan yung formula, makukuha mo talaga yung tamang ibabayad mo. Pag dineretso mo siya, pansinin mo, pag 3 million lang times 6%, ang makukuha mo kasi dyan is 180. Mali ka na. Kasi hindi lagi ang tax base ay yung selling price. Ang tax base mo ay the higher between selling price or fair market value. Kaya pagka partial utilization siya, huwag niyong kalimutan na i-proportion siya based on the selling price multiplied by the tax due. Multiplied by the tax due. Do not get it directly. Do not get it directly. Mali yung kukunin mo lang yung unutilized multiplied by 6%. This is incorrect. Okay? That is incorrect. The proper way is to get the proportion out of your tax due. Ulitin natin. If ever, full utilization, exempt. Partial utilization, taxable. So how do we tax if ever it is partially utilized? Unutilized divided by selling price times tax due. So dito, hindi natin na-utilize yung buong 7 million. Ang nagamit lang natin ay yung 3 million. 3 million divided by selling price of 7 million times 480 yung tax due, yun yung ibabayad natin. 205,714. Now, aside from determining the tax due, you also need to determine the tax basis of new principal residence. So if ever it is full utilization, the tax basis is the old residence basis. So for example, the selling price is 7 million, right? The cost is 5 million. You purchase new principal residence at 7 million. So in short, ginamit nyo yung buong selling price for the purchase of new principal residence. So the 7 million selling price was used to purchase the principal residence. What is the tax basis? The old residence basis. Old residence basis is the cost. So your answer here is 5 million pesos. How about if more than full utilization? How is this? The selling price is 7 million, let's say. The cost of the property is only 5 million. You purchase new principal residence for 10 million. You purchase new principal residence for 10 million. So in short, you utilize more than the selling price. Kasi ang selling price mo lang is 7 million, but you utilize 10 million. So this is more than. So reinvested more than the amount of proceeds. That is old residence plus excess investment. Our old residence basis, we said, is the cost of 5 million plus our excess investment. We invested 10 million, but we should only utilize 7 million. So this is the actual investment. This is only the selling price or the proceeds. So therefore, the new basis now is 8 million. The new basis now is 8 million. How about if partial utilization? So our example here is that our selling price is 7 million. Our cost is 5 million. You purchase new principal residence for 4 million. If the proceeds is not fully reinvested or underutilization or partial utilization, the tax basis is the portion reinvested multiplied by old residence basis. So we reinvested only 4 million out of the 7 million multiplied by 5 million. So 4 over 7 times 5 million. Our tax basis now, therefore, is now 8,2857143. Okay? Ulitin natin As to tax due. As to tax due. If fully utilized, exempt. Tax basis, the old tax basis, which is normally the cost. Pag more than full utilization, tax due is again exempt. The tax basis is the old tax basis plus additional investment. Pagka partial utilization, the tax due is again on your unutilized all over selling price multiplied by tax due. It becomes now taxable. How about the tax basis? Again, the portion reinvested that is unutilized all over selling price multiplied by the old tax basis. So question, is the sale of principal residence always exempt? The answer is no. Why? There are certain requisites that uh, you need to do, or there must be present, or it must be present so that we can say it is considered exempt. Particularly, it is fully utilized within 18 months and it is only enjoyed once every 10 years. If not, then it becomes taxable. Such in the case that it is partially utilized or unutilized in full. So as you can see, if partially utilized, it becomes now taxable. And the tax base will now change. Okay? So ingatan nyo lang to sa principal residence. Determine whether there's full utilization or partial utilization for the taxation. For the tax basis, you determine if ever it is fully utilized, more than fully utilized, or partially utilized. So we're done as to the taxation of your real property as to your principal residence. How about your other real properties. How about your other real properties? So for your other real properties, still tax base multiplied by tax rate will give you your tax due. So what is your tax base? As we said earlier, the tax base on your CGT on real property is the fair market value or the selling price, whichever is higher. So in our example a while back, our selling price was 7 million, but the fair market value was 8 million. The higher between the two was the 8 million. That's why we will tax it at 8 million. By the way, what is fair market value? Fair market value is the higher between zonal value. This is given by the BIR, and the assessed value given by your local treasurer. So the higher between the zonal value and the assessed value is our tax base. And by the way, you do it per type of real property. So for example, you are selling house and lot. You are selling house and lot. So let's say for house, and we have here your lot, you determine the higher between FMV and selling price, FMV and selling price. So let's say the total selling price of your house and lot is 8 million. The fair market value of your house, uh, the zonal value is, let's say, 2 million. The assessed value is 3 million. For lot, the zonal value is uh 7 million, and the assessed value is 5.5. So the higher of FMV for house is 3 million. For lot is 7 million, total of 10 million. So the selling price of house and lot, we said 8 million, while we computed our FNV at 10 million. So the higher between the two is 10 million, higher 10 million. Therefore, we tax it at 10 million. So if ever it is house and lot, just get the FMVs of both house and lot and compare the total FMV to the selling price. But if ever that is purely lot, there's no problem. Just compare the FMV over the selling price. But if it's bundled, get the bundled FMV, then compare it to your selling price. Now, the tax rate, we said that the tax rate of your real property is at 6%. Then the tax due is equal to your tax base times 6%. But take note, again, no tax due for the sale of principal residence. Sale of principal residence. Aside from that, there can be a tax due rule for installment sale. So what is that rule on installment sale? If initial payments is less than or equal to 25%, then you can pay in installment. And how do you pay in installment? You get the initial payments divided by your contract price. What are the components of your initial payments? Your initial payment is equal to your down payment plus your collection. Your contract price is equal to your selling price plus less any mortgage assumed by the buyer plus any constructive receipt. Plus any constructive receipt. Sir, what is the constructive receipt? Constructive receipt is the excess of cost over mortgage. Excess of cost over mortgage. Okay, let's say for example, you sold, the selling price is 7 million. The down payment is only 1 million. The down payment is only 1 million. And then the property is mortgage for 500,000. Mortgage for 500,000, and the cost of the property is only 600k. You mortgage it for 500, you mortgage it for 500, and the cost of the property is 600. Okay. First, we get for our down payment plus collection. Our down payment here is, initial payment is 1 million. Now for contract price. Our contract price is your selling price, which is 7 million, less any mortgage assumed, which is 500k. Now, you will only add if ever cost is greater than the cost, or the mortgage is greater than the cost. Okay? mortgage is greater than the cost. So excess of cost over mortgage. So mortgage is greater than the cost. So mortgage is 500 while the cost is 600. So is mortgage greater than the cost? No. Therefore, your contract price here is only 6.5 M. So 1 M all over 6.5 M multiplied by the tax due, then you determine if ever uh the amount now of our tax due. So for tax due, the selling price, assuming no fair market value, so 7 million times 6%, that is 420K. And now, determine the initial payments. Determine the initial payments. So the initial payments here is 1 million, and our contract price is 6.5. 1 million over 6.5 million. You multiply that to 420,000. The total tax due therefore is 64,615.39. 64,615.39. Okay, so here you just determine whether the initial payments is less than or equal to 25% of the selling price normally. Kung ititest mo naman ang 1 million over 7 million, for sure hindi naman yan papasok ng 25. Pero to compute for the tax due, initial payments divided by contract price. Another example is still our selling price is 7 million. The down payment is 1 million. The mortgage, let's say, is 2 million, but the cost is only 1.5 million. So first, our down payment, we learned that it is 1 million. Now for the contract price. For contract price, first we get for our selling price 7 million less the mortgage assumed of 2 million plus the excess of cost over mortgage. So our mortgage here is 2 million, but our cost is only 1.5. So we add 500K. So this will give us 5.5 million. So 1 million all over 5.5 million multiplied by the total tax due of 420, that will be our tax due. 1 million over 5.5 times 420, your installment payment now therefore is 76,363.64. 363.64. 76,363.64. Sir, next question. When can we pay when to pay next installment? When to pay next installment? Of course, 30 days after the payment. 30 days after the payment. So let's say, initial payment, ayan siya, and then nakakolect ka uli ng 2 milyon. So yung 2 million na yun, babayaran mo 30 days after the payment for installment sale. Okay? So, CGT on real property, just remember the tax base higher between fair market value or selling price. Tax rate is 6%, tax due, no tax due for full utilization of principal residence, and this tax due can still be made on installment basis. When can there be an installment basis? If initial payments is less than or equal to 25%. In short, it does not exceed 25%. If it does not exceed 25%, then it can be on installment. How do we compute? Initial payments divided by contract price. Initial payments is down payment plus collection. Contract price is selling price less any mortgage assumed plus any constructive receipt. What is a constructive receipt? That is the excess of your mortgage over cost. Sir, why is it considered a constructive receipt? Because the cost of the property is only like this. However, you have mortgaged it for more than the cost. So since you mortgage it for more than the cost, then it is considered should have been an adjustment on our price. An adjustment on our price. Okay, so that's it for our tax due on your real property. Okay, next, the compliance on the sale of real property. So earlier we said, if ever you will file BIR Form 1706. We call this one your capital gains tax return for onerous transfer of real property. So it is filed within 30 days following each sale, exchange, or disposition of real property. But what if it is an installment sale again? 30 days after the collection. 30 days after the correction. So for example, we collected a portion, then we will only pay 30 days after that collection. And how can we say that we are compliant with the taxes on the sale of real property? We have this so-called CAR. What is that CAR? That is your certificate authorizing registration. So it certifies that such sale has been reported to the BIR, and the capital tax or capital gains tax or creditable withholding tax, if any, has been paid. Sir, anong ibig sabihin yan? In a transfer of real property, there will always be a car before you can register to the registry of deeds. So bago mo ma-register ang property sa ROD, kailangan pala ng car. Before you can register to the registry of deeds, you need a certificate authorizing registration or your car. So how do you transfer a real property? A real property, by the way, is classified as a capital asset or an ordinary asset. So if that is a capital asset, you need to pay the CGT. If ordinary asset, we have the so-called creditable withholding tax. So capital gains, pag capital asset yung real property na yon, pero kung ordinary asset yung real property na yon, it is CWT. So to register, you will be given a certificate authorizing registration, CAR, by paying your BIR Form 1706.